first day of the year and the markets are down. And this is not just a one-day thing. Actually, you can see that the S&P 500 is down by almost 3% over the past month. What I'm trying to say is that the market is currently very volatile, and adding to that currently it is also extremely overpriced. I fear that 2025 won't be a great year. Now, there is one company that a lot of super investors are currently buying and which has been rising very steadily in price over the past 10 years without any major disruptions, and that company is of course Visa. And actually, if we have a look at Visa, we can see that over the past year it is up by 21.45%, and if we compare it to the S&P over the past 10 years, we can see that it has beaten the market by more than 100%. So will Visa keep rising in 2025 among the overpriced market? Well, to figure this out, we will jump to our stock valuation spreadsheets, where we will plug in the ticker V for Visa and all the metrics will show up automatically. Now, of course, if you want to download these spreadsheets, you can always do so in the link in the description. Now, jumping straight to the 9-pillar analysis, we can see that Visa gets a rating of 7 out of 9, with the 5-year PE ratio and the 5-year price to free cash flow being the only 2 pillars in the red. Now, if we direct our attention to the 5-year PE ratio, we can see that on average it has been sitting at 29, which is quite higher than the range we would like it to be in. But what you have to understand is that Visa is one of its kind company alongside with the MasterCard, and therefore it should be trading at a premium. Now, if we zoom into the 5-year PE ratio, we can see that Visa has been pushing it down successfully over the past 5 years, and in 2024 it was sitting at only 23.71, but then it rose to 32.31, which is higher than the 5-year average. Now, this large growth in the PE ratio is mainly due to Visa's rapid growth in stock price in 2024. And so yes, Visa would currently be considered overvalued compared to what they have been trading in the past. Now, that doesn't necessarily mean that in the long term it won't grow. And what we like to say on this channel is that the stock price growth of a company is mainly based on its profits growth. And so if we have a look at the revenue growth of Visa, we can see that over the past 5 years, on average, it has been increasing by 10.67% yearly. The free cash flow has been increasing by almost 20% yearly, and the net income has been increasing by about 16% yearly. And if we have a closer look at these 3 pillars, we can see that indeed Visa grew their revenue from 21.8 billion in 2020 to 35.9 billion in 2024. That is a huge increase, and that is the same case with the net income, which grew from 10.8 billion to 19.7 billion, and with the free cash flow, which grew from 9.7 billion to 18.7 billion in 2024. And so even though Visa is currently overpriced compared to their earnings and compared to their free cash flow as well, they do have a great foundation and very strong growth that will power their stock price growth over the next years to come. Now, I also want to show you Visa's earnings estimates. So if we jump to Seeking Alpha and go to earnings and earnings estimates, we can see that the analysts predict double-digit growth into the years to come. So into 2025, 2026, 2027, and 2028. And of course, as the intrinsic value of a company is a reflection of its profits growth, we can expect that Visa will rise in price at the sweet mid-digits rate. Now, not only does Visa have great profits growth, they also have great dividend growth. So if we zoom into pillar 8, the consecutive dividend growth, we can see that over the past 5 years, they have been increasing their dividends by 12.22% yearly on average, which is almost 3 times as high as an average company's dividend growth. And this certainly makes up for their lower dividend yield of 0.75%. If we look at the graph below, we can see that they grew their dividend from $1.22 in 2020 to $2.15 in 2024. That is almost a 100% increase in 5 years. Now, something you must understand is even though Visa has low dividend yield, thanks to their very high dividend growth, they will have a high yield on cost. So if we go to the dividend yield tab in Seeking Alpha and scroll down, we can see the yield on cost. So if you were to invest into Visa 5 years ago, your yield on cost would be 1.23%, which is quite higher than the current 0.75%. If you were to invest 10 years ago, your yield on cost would be almost 4%. And if you were to invest in 2008, your yield on cost would be almost 15%. So if you invested $10,000 in 2008, you would currently be getting about $1,500 every single year, accounting for inflation. And this is the power of consecutive high dividend yield growth, which really kicks in the dividend snowball effect. Now let's jump back to our stock valuation spreadsheets and have a look at some of the remaining pillars. First, let's have a look at Visa's 5-year profit margin, which is sitting very high, even compared to its sector, sitting at 97.34%. We can also see that Visa has been decreasing their shares outstanding at a very decent rate of 1.80% yearly, and that their long-term liabilities over the 5-year free cash flow negative dividends is sitting at only 0.48. And with this ratio being so low, and their trailing free cash flow payout ratio sitting at only 20.32%, Visa really has a lot of free cash flow left to push into dividend growth, which I very much love. So now that we have covered the 9 pillars, we can see that Visa is looking very promising. So let's calculate its intrinsic value using our 4 valuation models. Now in the grams formula, I will plug in a high earnings per share growth estimate of 20%, a medium earnings per share growth estimate at 14%, and a low growth earnings per share estimate at 9%. And when I combine this with the analyst projections, we get a 5-year earnings growth estimate at 13.70% yearly. We then combine it with everything and plug that into the grams formula and get an intrinsic value of $291.40, which is 8% lower than the current trading price. But as I said in the last video, the grams formula doesn't account for the fact that Visa is a premium company, and therefore the intrinsic valuation comes out a little lower than the current trading price. Now let's also jump to our second valuation model, the discounted cash flow model, where we take the free cash flow of Visa over the past 5 years and calculate the average growth rate to be sitting at 19.46%. Now into the future, I predict a high growth of 22%, medium growth of 16%, and a low growth of 9%, and this will give us a calculated growth rate of 15.7% into the next 8 years plus. Now to calculate the present value of that future free cash flow, we have to plug in the discount rate, which we base on the weighted average cost of capital of Visa. I plugged in the discount rate at 8.1% and calculated the present value of that future free cash flow. I then summed all of that up, added cash and cash equivalents, and subtracted the low total debt of Visa, and I got an equity value, which I divided by the shares outstanding and got an intrinsic value of $533.02, which is indeed quite higher than the current trading price, showing us that Visa really has great free cash flow growth. Now for the third valuation model, we will compare Visa to one of its competitors, and probably the only competitor, MasterCard. We will take MasterCard's stock price, divide by their earnings per share, and get their PE ratio, which is currently higher than Visa's, and therefore when we multiply this PE ratio with the earnings per share of Visa, we get an intrinsic value that is higher than the current trading price, sitting at $384.20. Now jumping to our final valuation model, the dividend discount model, we take the growth rate of the dividends over the past 5 years and calculate an average growth rate of 15.28%. I then project the growth rate into the future of 10.67%. But as this projected growth rate is higher than the discount rate we plugged in before, the intrinsic value comes out negative due to the mathematics within the dividend discount model. And therefore we will use our alternative model, which will give us an intrinsic value of $305.02, which is only slightly lower than the current trading price. So now jumping to the final ultimate valuation, we will average out the 4 valuation models and get an intrinsic value of $378.41, which is more than 20% higher than the current trading price, and with a margin of safety of 15%, we get an acceptable buy price at $321.65. Now based on this valuation and the research I did in the backend, I do believe that Visa will outperform the market in the years to come, and especially in 2025. And with that, if you did enjoy the video, consider leaving a like and subscribing, as it really helps me out.